We have with us today Mr. Sumit Shah, Chairman and Global CEO, Mr. Hitesh Shah, Managing Director of the company. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. I would now like to invite Mr. Sumit Shah to make his opening remarks. Over to you, sir.
Good morning, everyone. On behalf of Renaissance Global, I extend a warm welcome and thank you all for joining us on our earnings conference call for the quarter and year ended 31st March 2024. I will initiate the call by taking you through a brief overview of the company's operational and business highlights for the period under review. Post that, Hitesh will give you a rundown of our financial performance. As we reflect on the fiscal year gone by, our core markets continue to witness demand challenges. Despite that, we reported a resilient performance, ending the year with optimism driven by notable success of our high-margin direct-to-consumer business and an uptick in demand sentiment in our markets. Ending the year on a positive note, we have registered an improved performance this quarter with better operating margins. Our D2C vertical is showing promising growth and remains a key focus for future expansion. I would like to highlight that part of our strategic initiatives, we've reorganized our business segments. Our previous structure included divisions such as branded, customer brands, and plain gold segment. However, we have now realigned our focus to emphasize licensed brands, including Disney, Warner Brothers, DC, Star Wars, etc., as distinct from our own brands such as Irasva, Jewel Lily with Clarity. This shift also involves our exit from the plain gold business in the upcoming fiscal. We believe that this decision brings several key advantages. First, it streamlines our operations, enabling a more efficient use of resources and enhancing overall agility. Secondly, it contributes to deleveraging efforts, reducing our debt burden and strengthening our financial position. More importantly, this shift is anticipated to drive margin expansion and improve the return on capital employed and sustain profitability growth for the company. Coming to our segmental performance, our customer brands reported 13% revenue growth year over year this quarter, signaling a positive turnaround in our legacy segment. The EBITDA margin on the segment also improved to 8% in Q4 and 6.2% in FY24. Our licensed brand segment remains steady, achieving revenue of 437 crores in FY24 and 64 crores in Q4, with a notable EBITDA margins of 15.4 and 16.1% respectively. Meanwhile, our direct-to-consumer segment demonstrated revenue growth of 11% and 25% year over year in Q4 and in FY24, with EBITDA margins at around 6% for both the quarter and the year. I'd like to highlight here that our direct-to-consumer segment have high gross margins between 55 and 65%, and as we achieve adequate scale, we are confident that the EBITDA margins can be improved to 15 to 20% in the next 2 to 3 years. To further strengthen our foothold in the global jewelry branded market industry, we've expanded our license portfolio through strategic partnerships with Warner Brothers, DC, alongside our existing agreements with Enchanted Disney Fine Jewelry, Hallmark, NFL, and Star Wars and Disney Treasures. These strategic collaborations complement our direct-to-consumer branded business to support future growth. Also, post a successful debut of Wonder Fine Jewelry last quarter with a major retail partner, we have now introduced this collection successfully with another significant retailer. This expansion not only broadens our market reach, but also strengthens our brand presence across multiple retail platforms and increases visibility in the market. The company was also honored with an award in the jewelry category at the 50th Gem and Jewelry Export Promotion Council Award Ceremony. This accolade highlights our consistent performance and excellence in the jewelry industry, reflecting a commitment to quality, innovation, and customer satisfaction. As most of you tracking our industry are aware, a notable trend in the jewelry sector is a growing popularity of lab-grown diamonds. Currently, lab-grown diamonds comprise about 48% of our direct-to-consumer sales, highlighting their increasing demand among end consumers. Additionally, we have started recently expanding the use of lab-grown diamonds in our licensed brands, further enhancing their market presence. We also plan to expand the distribution of lab-grown diamonds to our Iraswa stores in India. With a presence of 4 retail stores, it should give us a toehold in the Indian market to sell lab-grown diamonds as well, increasing the contribution in the coming years. A few years ago, we made the strategic decision not to enter the manufacturing of lab-grown diamonds. This decision has proven prudent given the steep fall in prices due to large number of manufacturers worldwide. Instead, we focused on building brands around customer preferences using lab-grown diamonds. Today, we host a marketplace on our website featuring hundreds of manufacturers and suppliers of lab-grown diamonds, and the platform allows us to offer a diverse range of high-quality products while benefiting from the expertise of our suppliers. While this approach is harder in the long run, we believe truly that building a brand in the long run will be the correct decision and highly accretive to the margins of the company. Looking at our upcoming fiscal year, we are observing significant growth in our factory order book and mark substantial increase of 25 to 30% compared to the previous year. This growth is attributed to our strong expectations from all of our verticals. As a result, we anticipate an overall revenue growth between 10 and 15% for the year in our studded business in FY25. And due to leverage from the business, we expect an approximate 25 to 30% in the profit before tax for the year. The strategic outlook positions us for sustained growth and enhanced financial performance during the coming years. To conclude, we are witnessing demand green shoots across our markets, indicating a positive trend for the future, and we are confident that our strengths in product design, distribution, industry insights, and licensed brands will help us capture long-term growth opportunities in the global branded jewelry sector. Our strategy for the next 2-3 years centers on maximizing the benefits of our strong partnerships with the renowned brands, our distribution network, and the direct-to-consumer capabilities to drive revenue growth and improve margins. On that note, I'd like to hand the call over to Hitesh Shah to discuss our financial performance for the quarter and for the year.
Thank you, Sumit. Good afternoon, everyone. We have reported a resilient performance during the year gone by, supported by our branded jewelry segment, as well as a solid contribution from our direct-to-consumer business. In Q4 of FY24, our total income grew 7.5% at rupees 540 crores as compared to rupees 501 crores in Q4 of FY23. For the full year FY24, our total income stood at rupees 2,117 crores as compared to rupees 2,243 crores in FY23. On the profitability front, EBITDA grew 18.5% to rupees 45.1 crores in Q4 of FY24, and for the full year FY24, it came in flat at rupees 168 crores, translating into margins of 8.4% and 7.9% respectively. During the period, our margins rebounded, and we expect revenue to trend upward in the coming quarters. In Q4 of FY24, profit after tax came in at rupees 21 crores versus rupees 19.7 crores in the corresponding quarter last year. While for the full year FY24, profit after tax stood at rupees 73.6 crores against rupees 87.3 crores in FY23. Profitability was aided by improved contributions from a high margin areas of branded jewelry, primarily our direct-to-consumer business. As Sumit mentioned earlier, our business has been strategically recategorized into direct-to-consumer of our own brands and licensed brands, where we hold licenses for designing, manufacturing, and distributing jewelry via the B2B channels as well as our own websites. Our direct-to-consumer India brand, Iraswa, with 4 stores in Mumbai, Ahmedabad, and Hyderabad, achieved FY24 revenues of rupees 22 crores with a 3-year CAGR of 50%. Our US brands clocked FY24 revenues of rupees 165 crores with a 3-year compounded growth of 93%, reflecting our successful strategy and robust market expansion. In Q4 and for the full year FY24, our licensed brands business maintained a stable revenue of rupees 64.3 crores and rupees 437 crores respectively, supported by a steady flow of orders from retail partners as well as our own websites, with an improved EBITDA margin of 16.1 and 15.4% respectively. While our direct-to-consumer owned brands business saw a revenue increase of 24.5%, reaching 187 crores in FY24, with an EBITDA margin of 6%. In Q4, revenues grew 10.9% at rupees 47 crores, with an EBITDA margin of 6.3%. Further, strategically leveraging the growing popularity of lab-grown diamonds in the direct-to-consumer vertical, 48% of our sales now comes from lab-grown diamonds. This underscores their increasing preference among customers, particularly due to their significant price advantage over natural diamonds. For FY24, our studded jewelry business accounted for 88% of revenue, of which branded jewelry contributed 33%. Lastly, in terms of our balance sheet, our net debt to equity ratio stands healthy at 0.28 as on March 24. Our total net debt stands at rupees 322 crores, and our cash and bank balances and current investments stand at a healthy 188 crores. We have generated a robust free cash flow of rupees 431 crores over the past 5 years. Current inventory levels are elevated due to a strong order book at the factory level, which should support significant revenue growth in FY25. In conclusion, we have maintained a consistent performance despite challenging conditions. With our robust balance sheet, we are well equipped to navigate these adversities and anticipate even stronger outcomes in the upcoming fiscal year. On that note, I would now request the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Pavan Kumar from Ratnatraya Capital. Please go ahead.
Sir, can you speak more about lab-grown diamonds? And also, my primary questions are regarding post the steep fall in lab-grown diamonds, do we see any kind of threat in lab-grown diamonds themselves being generalized as a product and being used for something like an art or some stuff like that instead of just jewelry? And how do we see it? And also, I wanted to understand after this steep fall, wouldn't it have an overall impact on the revenues? How do we compensate? How do we plan to compensate for this?
Sure. So, there has been significant price correction with lab-grown diamonds, and hence, our decision strategically not to enter the manufacturing or hold inventory on the lab-grown side significantly, has kind of proven to be prudent. Now, in general, I think despite a fall in the prices of lab-grown diamonds, we have not seen an impact in consumption or demand for lab-grown diamonds. as a risk mitigation strategy for us as a company, we've always chosen to keep minimum inventory of lab-grown diamonds, and thus, try to sort of do it on an order basis primarily. Currently, we're not seeing too many use cases yet outside of jewelry for lab-grown diamonds. However, with prices falling, I think that there could be an expansion in use cases of lab-grown diamonds because, consumers have clearly demonstrated that there is a demand for it because most stones are almost close to perfect. And the cost to make stones bigger is not exponentially high as they are in the case of natural diamonds. So the design sensibility around lab-grown diamonds is shifting as compared to natural diamonds, and I think this calls for possible newer use cases in the future. We haven't seen anything meaningful yet.
Right. Okay. And how about so are we saying whatever sales drop we will see from the decline in value of I am just thinking about it this way. Let's say we did 100 rupees of sales last year, and let's say the prices have fallen by 60, and now we are doing 40. So are we saying we will compensate for 100 rupees of revenue through higher volumes, or how are we thinking about that in terms of lab-grown diamonds? Or because I understand the studded jewelry is 88% of your business, right?
Yeah. So I think one is obviously for us, lab-grown diamond primarily impacts our direct-to-consumer segment because in the B2B segment, as of now, it's a lower percentage in terms of total volume. So as the cost of lab-grown diamonds have gone down, we are not seeing decline in number one in retail prices to the same magnitude. So this has led to margin expansion and expansion of gross margins in our direct-to-consumer business. And number two, gold is also a significant component of the cost in studded jewelry since we don't sell just a commodity of lab-grown diamonds. So, I would say that on a blended basis, the realization decline has not been meaningful. And in our direct-to-consumer businesses, we have not seen any reduction in average order value. In fact, our average order value in our direct-to-consumer lab-grown business has remained consistent over the past few years, which means consumers have upgraded to slightly bigger stones and to better qualities. Most of lab-grown diamonds are sold in engagement rings, and consumers come with a budget to spend on an average on our websites around $3,000 for an engagement ring, and we've not seen that average order value go down. So it's a combination of multiple factors where a consumer comes with a budget, and they're generally upgrading to higher quality and better stones at the $3,000 budget.
Okay. So basically our argument right now is we have not seen such an steep price drop on the retail side as of now.
That's right.
Okay. On the gold business, I would have assumed since there the pricing is much more stable, we would have wanted to grow that business, but I understand you are planning for an exit strategy. So what is the reasoning behind that?
Yeah, so the gold business is a plain gold manufacturing business. This was an acquisition that the company did in 2016. The gross margins on this business are very low because of transparent pricing in the gold business. It's an internationally traded commodity, and thus it's very difficult to make greater than we've experienced, between 10 and 13% return on capital employed on that business. Our strategic goal as a company is really to grow around building brands. And the end of the gold business that we are in, we are essentially a contract manufacturer to large retailers. I think we want to evolve the company into businesses where we've got some pricing ability and pricing power, and we did not feel strategically as a company we would be able to make a greater than cost of capital in the plain gold business, selling to large retailers with limited pricing power.
Okay. So, do we do lab-grown diamonds even in Irispa, or we don't do that?
We are planning on launching lab-grown diamonds in all of our Irasva stores on July 1.
Okay. Got it, sir. Got it. And can you just comment on the working capital side also, sir, since it seems to have gone up from around 170 to 220 days odd?
Yes, so I think currently there is a temporary elevation in inventory because we have a very strong order book at the moment. I mean, it is a little bit elevated. The working capital will reduce during the course of the year as number one, as we exit the gold business. So there should be around 75 crore reduction in working capital due to the exit from the gold business in the next 2 quarters. And I think just in regards to the general order book being high has led to a temporary increase in the working capital, which I think will course correct during the course of this year.
Okay. And on your both D2C and licensed brands, what are the kind of margins we are looking at over a medium to long term?
Yeah, so currently, the licensed brands, is in the 15 to 17% range. Direct to consumer, as we scale, our goal would be to be in the same margin range, but I think that journey would take 2-3 years as Irasva is kind of is still loss making at the moment, so it's dragging down margins. And the US direct to consumer brands are also in the phase of growing. So as they mature, we'll experience operating leverage. I mean, the good news is that the gross margin on direct to consumer are between 50 and 65%. So with scale, it is relatively easy to actually get to the 15 to 17% kind of EBITDA margins. So our goal would be that over the next 2-3 years, in a calibrated manner, to increase the margins for the direct to consumer, our brand segment, to that 15 to 17% margins as well.
Okay. Fine, sir. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask questions, you may please press star and 1. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. Am I audible?
Yes. Go ahead.
Okay. So, firstly, my question is with respect to the plain gold business. So, what is the net worth of this business, and what value do you expect from the exit of business?
Yeah, so I think currently we are evaluating, alternatives, and we're talking to, a few players who would be interested in making an acquisition. I think that we will know, in the next quarter or two exactly, the process of exit from this business. The working capital involved in the plain gold business is, around 65 to 70 crores. And, in addition to that, there will be fixed assets of 15 to 20 crores in the business. I think, the price at which we are able to sell, I think we'll know only closer to time as the negotiations sort of reach the final stages. So I think that there is around 75 crores invested in the business in terms of capital, which over the next 6 months we expect to, be able to fully exit.
Okay. And opposed to exit the plain gold business, what would be the ROE profile for our company for the remaining businesses?
Yeah, so I think that the ROE profile in the last couple of years, as we've experienced sales declines, has worsened. However, our expectation would be that in the next 2 years we'd like to be in that 15 to 20% kind of return on equity range, and we will keep refining our business strategy in order to get to that 17 to 18% over that time period. And I think the couple of areas where increased profitability will help is, one is exit from the plain gold business, and number two would be the improved profitability of our direct-to-consumer brands. As over the last few years, we've made significant investments in our own brands, and the business has only become profitable, as you see in the current year and marginally in the previous year. So as those businesses reach scale, we expect to get to our return on equity targets.
Okay. And so for FY25 and FY26 as well, what is our revenue growth guidance and EBITDA margin guidance, if you could share, please?
So I think that in our current outlook, we've guided for X of the plain gold jewelry business between 10 and 15% growth in revenue, and 25 to 30% increase in profit before tax for the current year. I think it's a little bit soon to talk about FY26, but we are seeing a lot of demand green shoots in our business in terms of recovery in the US markets, with inflation now moderating and lab-grown diamonds gaining increase in popularity. So we're focusing on these growth areas of lab-grown diamonds. We see a lot of potential in the India business as well. So I think that over the course of the next 2-3 years, our aspiration would definitely be to get to double-digit EBITDA margins. I think it's going to be a journey to get there, and we've presented sort of the matrix within the three businesses in terms of what's dragging down our EBITDA margins and where we need to focus on in order to get the sum of the parts margins to double-digit numbers. We have the licensed brand segment, which is already at a 15-16% margins, and we believe that the direct-to-consumer businesses should also get to those kinds of margins in the years to come. And we're looking at sort of cost optimizations within the customer brand segment in order to improve margins there as well. So I think with the scale that we've reached, I think that it's possible now to optimize costs to get to significantly higher margins from where we are today.
Okay, and just one more question. But the tax rates are very less.
Sorry to interrupt, Rishikesh, but you are not clear at the moment, sir. You sound muffled as well as the line is breaking up in between.
Am I audible to you now?
This is much better, sir. Please
Yes.
go ahead.
Yes.
Okay. My question was on the tax rate. Our tax rate for this quarter is very less. So, what tax rate would we be in FY25 and FY26?
So I think our annual tax rate, ends up being in the 15 to 20% range. I think that there are quarterly variances, but I would say that on an average the tax rate would be in that 15 to 20% range going forward.
Oh, got it. Thank you.
Thank you. Ladies and gentlemen, if you wish to ask questions, you may please press star and 1. To ask a question, ladies and gentlemen, you may press star and 1 on your touchtone phones. We have the next question from the line of Ashish Shah from Centrum PMS. Please go ahead.
Hi, Sumit. Am I audible?
Yes, go ahead, Ashish.
What implications do you see of this winding up of this gold business in terms of you see any write-offs, some capital provisions you might have to do because of that?
No, currently at the moment, we don't anticipate any write-downs on anticipation of exit from the gold business. Current expectation, would be that we should be able to recover capital invested from the business. Yeah. So that's, currently we're in early stages of discussions with potential buyers. So I don't have too much further information to share, but our current expectation is, because the primary investments are working capital, which is primarily gold, on which there should not be any write-downs. And the other investments are really only 15 crores, and which is also primarily in real estate. So currently, based on our expectations, we don't expect any write-downs due to the exit from the gold business.
Okay, that's helpful. Can you talk a little bit about Iraswa, like for the year ahead, a couple of years, like what plans have we now formed up in terms of new store openings and?
Sure. So, currently we are opening our fifth store on June 18th in Mumbai, and I think that the current plan with Iraswa involves introduction of lab-grown diamonds into all of the stores, which will help the blended margin of the Iraswa business to increase meaningfully. We are going to monitor turn to profitability for Iraswa in the current year, and then plan any further store expansions. Currently, we have no further store expansions planned. And we believe that the current 5 stores, and we plan to shut down the store in South Bombay, Hughes Road, simultaneously with the opening of the Bandra store. So the network for Iraswa will be 4 stores, and we believe that the business should be at least 50% higher than what it was last year in the current year. But I think our expectation would be to get as close to profitability as possible before expanding the network base. So I think with the introduction of lab-grown diamonds and the weighted average margin going up, the current business plan is for a 50% increase in revenues this year with expectation of close to break even or slight profitability, based on which we will increase the store network in the following year.
Okay, and has your has our traditional B2B business, you spoke about some green shoots. As you go back in time, typically when the US economy stages a recovery, is it too early to say that we are on a growth path now? Would you hazard a guess that looks like that 2-3 years out also growth is looking up?
Yeah, so I would say that in July of 22, as inflation hit that 8-9% number in the US, most discretionary products in the US definitely saw a drop in demand. I think with inflation coming down, we are seeing strong green shoots of demand recovery in the US, and which is indicated by our factory order book, which as of April 1 was about 25% higher than what it was 1 year ago. So I think we're currently cautiously optimistic about a recovery in demand, and sort of this shift to lab-grown diamonds is also helping increase overall consumption. So we are quite hopeful that we should see sort of growth in the coming years and some demand stabilization now. I think after an 18-month period where the economy went through, especially discretionary categories, went through subdued demand patterns.
Okay, and a couple of things on your US brands. The way we now report that under our new disclosure norms, you see them reverting back to high double-digit growth, right?
Absolutely right. I think that what we've done on the US brands front, we've increased gross margins significantly, due to which in Q4, and we were in the middle of transitioning our digital marketing agency, growth moderate a bit. But our expectations would definitely be that we would continue with high double-digit growth for the US brand segment for the coming year.
Okay. And just a bit on the margin profile of US brands. I think you did mention last quarter that you all took meaningful price hikes, right? I think over there. Yet, in terms of the EBITDA margin, hasn't really doesn't seem like that's gone up for the US brands.
Yeah. So I think that it will show up in the coming years. I think that this quarter we've sort of changed our digital marketing agency, due to which there were some marketing inefficiencies. So a large part of cost is customer acquisition cost. And despite higher gross margins, there were some inefficiencies that crept in due to lower return on investment on the digital marketing front, which you see now is a very substantial number. So I think that for a 12-month period, you should definitely see a substantial increase in margins, because currently we are investing almost 35% of sales on customer acquisitions. And any small inefficiency there can have an impact in margins, but over time, as we see a higher customer repeat rate, the plan would be to reduce spends on customer acquisition costs and thus improve margins.
Okay. And the way you thought about like restructuring a business, essentially what drove winding off the gold business seems like ROC was a prime consideration. Any other thoughts which could improve this ROC, like over the next 12 months, 18 months, which could be any low-hanging fruits that you can think of?
Yeah, so I think that if we were to look at the three remaining segments, customer brands, licensed brands, and our brands, on the customer brand segment, I think ROC will improve with operating leverage. We've seen that for the last 2 years, our EBITDA margins have gone from 7.5% to 6% over the course of 2 years due to operating deleverage. We expect with recovery in demand, those margins could go up. On the licensed brands front, I think it will be business as usual. I think that the ROC is already very healthy on the licensed brands front. And on the direct to consumer brands, I think that with scale, there's going to be significant operating leverage on the US brands. And on the India front, I think we think that the introduction of lab-grown diamonds, whose gross margins are significantly higher than natural diamonds, will help improve profitability and thus ROE, ROC profile. So I think in general, increase in profitability in each of the segments has different vectors which will impact it. And I think that we're working on all three fronts, customer brands, US brands, as well as Iraswa, to help improve the profitability and the return on capital employed.
Okay, Sumit, one last question on your licensed brand business. Anything else in the pipeline that you would want to share with us?
So we recently have are in the process of testing the Barbie collection with one of our large retail partners. We've seen some test results from Mother's Day. We are yet to fully evaluate how meaningful that will be. But currently, that's sort of the new license that we've launched and working on after Wonder Fine Jewelry. So I think that depending on the success of that, we should see some healthy growth. We're also in the process of introducing lab-grown diamonds in all of our licensed brands as well. So that should be kind of another growth driver for the licensed brand business.
So currently the entire licensed brand, the B2B portion is all non-LGD?
Yes, that's right.
Okay, Sumit, thank you very much and all the best.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Chirag V from Budrani Finance. Please go ahead.
Sir, post your selling of the plain gold business, where do you think the inventory and the working capital days will be?
So I think the inventory will the direct impact of this business. Obviously, there will be puts and takes, and depending on the working capital in the plain gold business. But net there is around 70 crores of working capital invested in the plain gold business, which should get released in the next 6 months as we exit that business.
Okay, sir. Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Participants who wish to ask questions may press star and 1. We have the next question from the line of Rishikesh from Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. So I think in our PPT, we have bifurcated our B2B and B2B business in our own brands and licensed brands as well. Can you bifurcate within only D2C what would be our revenues, and only for a B2B business what would be our revenues?
On the licensed brands?
No, both, including both license as well as our brands.
So in our brands, we've already disclosed that 187 crores is direct to consumer. So this is the 187 crore revenue for the year is all our brands sold direct to consumer. In the licensed brand segment, the breakup is about 75-25 between B2B and B2C. So about 75% of the licensed brands are sold through retail partners, and 25% of the sales is direct to consumer.
Okay. Thank you.
Thank you. Participants, you may press star and 1 if you wish to ask questions. As we have no further questions, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. Hopefully, we've been able to answer all your questions. Should you need any further clarifications, please feel to contact our investor relations team or CDR India. And thank you very much.
Thank you.
Thank you. On behalf of Renaissance Global Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.